We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Irons from the Quoth the Raven podcast. We're going to split this conversation into two, and the second part we're not going to be putting on YouTube because we've had some censoring issues recently. So if you want to hear the second part where we dive into a little bit about COVID, some philosophical ideas, and just some general talk about life, that's going to be available on all of our audio platforms, as well as Spotify, Rumble, Odyssey, and anywhere else you get your podcasts. Welcome back, Chris. How are you?
Tom, I am so happy to be back. I'm thrilled, actually. I'm doing great. How are you?
I'm excellent. We're kind of chatting a little bit before we started here. Both rang in the new year, fresh slate. You know, hopefully you don't necessarily need to change a whole bunch in your life to be able to look forward to the new year. But yeah, it's always great to have you back and to chat because, you know, you look at a lot of stuff outside, let's say, necessarily the particular gold space. You know, you've looked at China quite a bit. You have quite a bit of experience that I don't necessarily get to be exposed to on a daily basis. So it's good to be able to have a chat with you and also read your blog from time to time because it really helps bring some new ideas, other, let's say, risk areas into my thinking for sure. So maybe we can kind of start there. Why do you think that 2022 was maybe a prelude for volatility in the markets?
Well, look, what I think is that 2022, we saw a lot of volatility, but not as much as we're going to see in 2023. And by volatility, I don't necessarily mean that the market is going to crash all year long. But what I do mean is that I think in 2023, we're going to see capitulation. We're going to see fear and panic in the markets at some point. I think it's a mathematical certainty just based on the fact that interest rates are now at 4%. Neil Kashkari said this morning that, you know, he thinks rates should go to 5.4% before the year is over, which is hilarious because just last year he was predicting 1% rates for this year. So he is gone, okay? He's on Jupiter, he's on Mars. But regardless, the point is, like some of these other Fed governors, he's talking about finding the neutral rate at, 5.5%. And as everybody knows, the economy and the market respond to higher interest rates with a lag. And so we raised rates as aggressively and quickly over 2022, almost as we ever have at any point in recent history. Certainly leading up to 2018 when the market crashed during the holidays in 2018, we had been moving in 25 basis point increments for, I think, 2 or 3 years at that point. What we did in 2022 is we went from 0 to 400 basis points, in 12 months. And all that means is we're going to get probably an even more pronounced response from the markets. But because all of that happened in such a shorter period of time, it's going to take, we're still kind of waiting for the market to respond. It hasn't had 2 years. It hasn't had 3 years, but you're starting to see it in the macro data this morning. New mortgage applications down 13% this morning versus, I think, 1 or 2% in the year prior. We're going to start to see it, Tom. The ISM numbers are coming in under expectations. Every macro data point that you could look for has come in indicating that the economy is starting to grind to a halt. It'll show up in earnings. It has already started to show up in earnings. It has showed up in massive company layoffs, which we saw, getting started in 2022. When I woke up this morning, I always read all the news headlines every morning. I think like 4 of the first news headlines I read this morning, Salesforce and like 2 or 3 other companies all cutting their staff by 10%, cutting their staff by 5%. And so that will continue into the new year. And as those things will continue, the market and the economy are going to catch up. The economic data is going to get worse, and the market is going to throw a fit at some point. I mean, a real fit. I've been way ahead of this because, look, I started writing in November 2021 about the NASDAQ potentially crashing. That was before inflation was on the map, and it was before Russia invading Ukraine was on the map. And my thesis was basically, look, the market was at hyper elevated points prior to COVID. Then we introduced all this hot money into the system. Then all of a sudden, weaponized gamma became a thing, right? Where SoftBank, Goldman Sachs, all these companies, if you can read in the Financial Times, did some great coverage on it, that these companies were basically utilizing options to move the tech indices, which is why you saw the NASDAQ basically double off its post-pandemic lows in March of 2022. For an index, that is a perverse move. That is a stunning move for an index. It's an insane move for a blue chip company by itself, but for an index, it has to be a 6 or 7 sigma outlier. I don't know what it is, but it's ridiculous. And my point in November 2021 was, look, prior to the pandemic, we were already saying that everything was overpriced. Well, what happens when you take overpriced and on top of it, you layer basically what I thought and still think was a completely artificial burst higher, euphoric kind of, bubble burst higher, overdrive, afterburners, overclocking essentially of the market. And that is what I think we saw from March 2020 to like the end of 2021. Now you have a couple of things all converging at once, right? The hot money spigot has been turned off and rates are rising. Personal savings are drying up. Consumer credit is rising to record levels. And what does that mean? It means that not only are people going to be feeling the crunch of all of the pornographic amount of debt that is outstanding now, and not only is the cost of carrying that debt going to rise, but on top of that, don't forget we have to give back all of that artificial move higher, which I think is what we're seeing in Tesla right now. We could talk about that in a second. We have to give back all of that artificial move higher that I believe was basically caused a lot by weaponized options, weaponized gamma. And then, we give that back. And then where are we, Tom? We're at the ridiculous nosebleed levels we were prior to the pandemic. I mean, people forget 2018, 2017, 2019, you had Yellen saying assets were overvalued. You had Carl Icahn putting out videos saying that the market was overvalued. I mean, it was widely accepted that the market was extremely overvalued in 2017, 2018, 2019, right? Then on top of that is when we, kind of blew this bubble that much bigger thanks to all the COVID stimulus. So you rope back in all the COVID stimulus, then you're back at where we were prior to COVID, which was extremely overvalued. Then you got to take extremely overvalued and you need to head back somewhere towards your recessionary means, as in averages, right? Your market cap to GDP averages, your S&P earnings ratio averages. And I know this doesn't necessarily account for all of the new money in the system, but the point is, from this point going forward, there's a really strong case, especially obviously now with the macro environment with rates where they are, that the market still needs to come in another, maybe 40% from here, I think, before we can even start talking about a bottom. On top of that, and I hate to be long-winded, but on top of the fact that you had a euphoric bubble on top of an already overvalued market, now heading into a year where rates are at a ridiculous amount, 4% heading to 5% maybe. On top of that, you have all of this geopolitical and global economic risk that was nowhere to be seen prior to Russia invading Ukraine. So we are at the beginning of, in my opinion, a brand new epoch for the global economy in general. And, as Larry Lepard said on some podcast I was listening to today when I was running, trends are trends for a reason, because everybody moves in the same direction and everything, but trends do eventually end. And I think that we're heading to the end of a major decades-long trend in markets as we roll into 2023 here.
Well, yeah, you recently wrote in kind of a summary of 2022, this tweet thread, that it's been something like almost 15 years since we've really had interest rates this high. And you and I have talked about the idea of lag, of these rate hikes having their full effect, what that means for the balance sheets of companies going forward. But that the other part of this that I wanted to kind of touch on a little bit more was kind of summarized in one of your articles called Tapped Out, where you talk about how this is really affecting Main Street or the average consumer. You investigated a little bit about how the hikes have affected people's personal balance sheets, how it's affected their mortgage rates, all of those types of things. So do you think that the average person is very close to being, as you said, tapped out?
Well, yeah, I do. I mean, I feel like the average individual that has relied on, look, here was the narrative coming out of COVID, right? Personal savings were up. Why were personal savings up? Because people were out generating more productivity? No, because people were sitting at home collecting more in unemployment than they had ever had in the past. And the government was doling out PPP loans to anybody and everybody, including people like Ross Gerber, who took PPP loans. What does that mean? It means that anybody could get a PPP loan for anything. That's what it means. So the government, which, and again, this is another mind-boggling exercise in government efficiency that we could dedicate an entire podcast to, but we won't. What does the government do? Okay, it takes a couple $1 trillion. All right, Tom, and it sprays it at the country. All right, like a guy holding a fire hose. Just any amount of money in any direction with no accountability. They nailed some people for fraud, sure, but the amount of waste and abuse and wrongdoing and corruption that occurred with this money is off the charts. Okay, off the charts. And when you think about things like that, that's what makes it difficult to understand the thinking and tracking people's $600 Venmo transactions. But again, another discussion for another day. All of that money took the personal savings rate. And if you pull up a chart of the personal savings rate in the country, or whatever the hell it's called, average household savings, you can pull it up on Fred. You see there's this enormous spike, okay, when all of that happened. All of that has been drawn back down, okay? Those savings have been spent and then some. So the savings are now underneath where they were prior to the pandemic. And on top of that, what happens when you run out of savings? What do you do next? Well, you go and you start taking out credit cards, right? You take personal unsecured loans, you take home equity loans, you take on debt, right? Once you run through your savings, the only place to go is to debt, right? And so what have we seen? Not only have we seen the personal savings get drawn down, but we've seen, consumer debt levels spike to like recent record levels. So what does that mean? It means that we are running on very, very, very thin ice in terms of, liquidity as a country. And as rates continue to rise, all right, because remember, rates are still rising. The effects of rates rising don't take place right away. They take place in the quarters after they rise. Every time rates tick higher, everybody's debt gets a little bit more expensive, which essentially just means that everybody has a little bit less discretionary income. The cost of the mortgage goes up what? Maybe it goes up $75 for a household. Well, you multiply that by, 100 million households, and all of a sudden you're talking about a material sum of money. Those numbers are still in the process of going up because all that stuff operates on a lag. Those costs are still getting more expensive. And if super genius Neil Kashkari has his way, those numbers will continue to rise well into 2023. As that happens, discretionary income that is used to, buy products or services, or income perhaps that people were saving or putting away or trying to put in their 401k or put into their brokerage accounts, all of that contracts. So what does that mean? It means that money comes out of the market, which sucks, and will ultimately feed on itself when markets start to move lower. But it also means as spending goes down, all of these companies, you basic household consumer staples, anybody that sells anything, business is going to decline. Business will start to decline and earnings will start to contract, and what happens when earnings contract? Well, then the price you're paying for stock winds up getting more expensive. And so stocks re-rate. And what happens when stocks move lower? Well, then people get margin calls and they're forced to liquidate, or they notice the value of their 401k, going down instead of going up, and people start to cash out. So it becomes this pretty gnarly cycle, basically a basic econ 101 like deleveraging cycle that takes place. And so my argument is heading into 2023, we're not even in the thick of that yet. That flywheel is just barely starting to spin up here, and shit's going to get real this year. The other thing to consider is when that starts to happen. So here's what everybody will say, right? Everybody's going to say, when we have our first limit down day, or, limit down 2 days, or the market drops 15% in a week, because I agree with Lepard, right? The Fed has this third mandate, which is essentially financial market stability that nobody talks about. So what would prompt the Fed to act? Well, if the S&P took a 15% shit in 48 hours, that might start to turn some heads. That's, it's certainly get the lobotomized automatons in Congress who know little about anything and even less about finance to start to moan and complain to Jerome Powell that he's doing his job wrong and start to create pressure on the Fed. I'll never forget 2018. Steve Mnuchin called the banks. That's what he did. He called the banks after the market crashed, as if that meant anything at all, and dutifully reported back that, I just got off the phone with Jamie Dimon at JP Morgan, who tells me, the banks have ample liquidity. It's like, okay, what does that have to do with anything? Stocks are down 10% over 2 or 3 days. It just will cause panic. That panic will beget other panic. This is when you see financial news anchors crying on the air and all that kind of fun stuff that I personally can't wait for, but other people are horrified by. So the point of the matter is that people think that the Fed will come in and immediately make policy changes, and they probably will, right? I don't know if it'll start with saying we're not going to raise anymore. At some point, they'll take more of a dovish stance. I don't know if they'll cut right away. I don't know what they're going to do, but the point is it doesn't matter, right? So my point is, heading into 2023, in another article that I wrote on my blog, it's called Why Timing the Fed is Not Timing the Market, is just a reminder that even after the Fed acts, right, because I do think we are going to see limit down days in 2023, and I don't think it's going to take very long. So, I've been saying it for a year, but it really is starting to feel like 0 hour is upon us. And I said all of this stuff happens with a lag. What I think will happen is then the Fed will act, and I think there will be a misunderstanding by the market that everything is fine once the Fed acts. But that doesn't mean anything, because these policies, first off, they've overshot the mark, which they don't even understand, and they won't understand until the economy implodes onto itself like a dying star. Stay tuned in 2023, it'll happen. In addition to that, making another policy move is it will operate on a 6-month lag. It'll operate on a 12-month lag. Jim Chanos tweeted out a couple of weeks ago, hey, just a reminder that, Lehman Brothers collapsed a year after the Fed pivoted, right? So
yeah, that was actually something I wanted to go over with you is looking at those examples. Do you think they're important or instructive?
It is important because people will need to understand that just because the Fed is pausing or cutting, that doesn't mean that everything's okay. It doesn't mean that the path is clear. It doesn't mean that it's green lights all the way through. And I just think I think it's important to remember that timing the Fed and timing the market are two completely different things. We're in a much more precarious spot than we think we are right now. We don't know, and we won't know until we wake up one morning and it bludgeons us in the face, not unlike COVID did, not unlike past market crashes did. I mean, Tom, we knew each other back then. When COVID first started, January, February 2020, all I was saying is markets are going to crash. This is terrible. This will come to the United States. You'll see. This is a global problem. Nobody wanted to hear it. The market went up every fucking day. The market went up. I did a podcast called Pandemic and Pandemics and Other Things That Make the Market Go Up, right? Which is like a snarky way of saying like, hey, we're on the verge of a pandemic, buy stocks, right? Because that's what every asshole was doing. Well, what happened? February came and went, March came and went, and then all of a sudden we woke up one day and everybody's head was sewn to the carpet, right? Because everybody realized, hey, we're on the verge of a pandemic. And why didn't anybody tell us about this? It's like, open your eyes, right? So it's the same situation now, right? I know what I'm looking at. You know what we're looking at. Your listeners know what we're looking at. Your listeners understand that $31 trillion in debt times 4% interest rates equals a disaster, right? I don't need to run the calculations for you. I don't need a graphing calculator. I don't need a spreadsheet. I don't need to even understand anything about how the system works. I just need those two big numbers to give you a bird's eye view that this just isn't going to work. It's, square peg, round hole, smashing them together, not happening, right? Very, very, very simple. Bird's eye, 30,000 foot view of things. Something's going to break. Where, when, how? I don't know. It was like with Celsius, we talked about that before that happened, right? What did I say to you? I said, look, they're offering 15% yield on their product. I don't understand the inner workings of any of this, except for the fact that it just doesn't make sense, right? Alex Mashinsky went on Kitco with Peter Schiff and ridiculed him, told him he didn't understand things. 3 months later, he was filing for bankruptcy. I expect the United States government to do somewhat the same.
Chris, that's something I'd like to kind of get your thoughts on a little bit more, is if you think that the Fed has really trained investors to, jump back into the market as soon as they come back to the rescue, as soon as they pivot. When in March of 2020, we saw the markets crash as you and I were discussing. And then all of a sudden we saw this, insane rebound. And this seems to me like, the perfect opportunity for people that maybe missed that. And they're salivating on the sidelines, waiting for the next time that happens. Do you think that they've really trained investors to jump back in with both feet?
Well, it's a little bit of a different situation. Because rates were at zero then, and our rates were at, I forget what rates were at in March of 2020, but like 1.5%, 175 basis points, and then we cut to zero. Look, the point is, if the Fed came out tomorrow and said they were going to do $10 trillion in open-ended QE, and they were going to slash nominal rates to negative 1%, there's no doubt that the stock market would go much higher. The point is, it's just not necessarily going to happen right away, because you have all this detritus that needs to work its way out of the plumbing of the system, right? First. So you got to kind of force all the turds out of the system first before you can allow the clean water to come through the plumbing, if that makes sense. If that happens, me and you will be on a yacht somewhere in the Mediterranean, because gold will be at $5,000 an ounce overnight, and gold miners will be at 25x at that point. And, who knows what we'll be doing at that point, Tom? Maybe we'll invite the listeners. I'm sure that many of your listeners have much higher net worths than I do and have much more invested in gold and silver than I do. Maybe one of them will invite us out and we'll just go party on the Mediterranean for a week or two, like the world's ending. Look, markets will wind up going higher, but there will be kinks that need to be worked out first. I don't think the Fed is going to do that. There's a huge difference between slashing nominal rates to negative 2%, which the Fed just can't do. They just can't do it. We'd have 20% inflation. We'd be talking about hyperinflationary scenarios at that point. So they don't have the option to do that. What they have the option to do is peel back 5% to 3% rates, right? And that's, first off, lest we forget, current monetary policy, when you're talking about real rates, is still accommodative, lest we forget that, right? Mm-hmm. It's still not restrictive when inflation's at 6 or 7% and rates are at 4%. You're still talking about negative 2 or 3% real rates. The Fed doesn't have the option to make a major massive cut like that. What they would do is they would maybe do 150 basis point cut, right? Would be like their big, that would be the big like bazooka, and say, all right, well, we're gonna start bond buying. I don't even know. It's just a reminder that like that doesn't mean the problems are solved, and quite frankly might also trigger a loss of confidence in the Fed. When you start talking about situations like that, or like yield curve control, if the bond market starts to kind of lose its shit, you have to have another discussion, which is this loss of confidence in the Fed type discussion that I think it was Luke Groman was talking to you about a couple months back, maybe October, November. I remember listening, because that's really that's going to be the next big elephant in the room. And when you look at things from a geopolitical spectrum, it's clear to me that China, Russia, Saudi Arabia, India, they all know this already. I mean, there's a good reason they're stockpiling gold and doing their best to try to create a monetary system outside of the one being used by the West. And a lot of it has to do with, their loss of confidence, probably in our central banking system. When we wake up to realize that, the same loss of confidence that they've kind of already figured out, well, then it's panic time, then it's like Katie barred the door kind of time for sound money and just for general lunacy and austerity. And, that's I don't know, that's the situation where you talk about, people that hoard gold and guns. I don't know if it happens, but I certainly know that it feels like now it's more of a possibility than it ever has been. Let me just tell you something, Tom. When the Fed came in and they implemented QE in March of 2020, QE Infinity, one of the things that I said was, I'm getting long some stuff, right? Just as the market was crashing, the day that Bill Ackman was on national television crying about how the markets were crashing and COVID was going to devastate the world, was right about the time I did a Periscope called Being a Contrarian in the Time of a Pandemic or something like that. And I said, look, I'm going to start looking at financials here because this isn't a financial crisis, basically because I still had confidence, a degree of confidence in the Fed, saying, all right, the Goldman Sachs is okay here at, 0.5x book, which is cheap for a bank. This is not a systemic financial crisis. This is going to be an earnings crisis. It's going to be, a different kind of crisis. And so I started saying, this is the time to look at the blue chips, the names that, maybe if you wanted to be a long-term investor, this would be the time to look at those names. So the point of saying that is to just kind of set the stage that I'm capable of playing within the system too, right? And that was one thing I had to learn. When I first discovered the entire central banking model was a Ponzi scheme, I was like, okay, short everything always. Then you kind of learn the hard lesson of don't fight the Fed, which as much as you hate it, because what they're doing is morally repugnant, as much as you hate it, it makes you money, right? There's one of my friends said to me years ago, bears sound smart, bulls make money. And it's so dumb. It's such a stupid saying, but it registered with me. And it makes sense. They're like, yeah, you do sound smart because you got it figured out, but are you smart enough to play the game within the confines of the game so that you can make money, right? Because if you're long gold because the system is fucked, but gold is going to go down 50% over the course of a year, you're down 50%, regardless of how right you are on macro. So look, that's setting the stage for the idea that I don't have any problem playing within the confines of the game. It doesn't bother me to change my mind. It doesn't bother me to have a grasp on things and, try to use that grasp to make money. However, with that being said, now I feel like we're on the cusp of something that could usurp that entire system, could usurp all of the rules of the game from March 2020. And that's when you start talking about a loss of confidence in the Fed. That's when you start talking about a loss of confidence in the central banking model, in fiat, in the US dollar as reserve currency. And what are we seeing now? We're seeing all these things that we've never seen before. I mean, we've never seen, the US just grab somebody's reserves and basically just steal them like we did with Russia's, right? What signal does that send to the world? It sends a signal that like, hey, we could just take your shit whenever we want, right? So even Germany, even our allies, right? What do they think when they see something like that? Well, they think, wow, if we piss off the US, who knows what recourse they have. And so it gets the rest of the world thinking. And along those lines comes the idea of like, well, how does the US actually sustain its quality of life despite carrying all of this debt and, managing all these trade deficits? Doesn't really make sense. Oh, okay. Well, that begets the question of like, all right, what gives the dollar its reserve currency status? And it's like, okay, well, the petrodollar. And then, it's like, all right, well, who are the Saudis allied with? Are they allied with Russia and China? Or are they allied more with the US now? And all of a sudden, all these wheels start to turn. And, Russia basically laughed at the sanctions that we put on them. I mean, they endured some pain, but they said, all right, we'll just stick it out. Like, we have the oil. Mm-hmm. China has the productive capacity. And all of a sudden, now they're paired together. China's going to invest in, Russian oil assets strategically. Russia's going to help China. And I'm sure China is one way or another helping Russia militarily as well as we, help Ukraine. So the world is bifurcating right in front of us, and they've made no secret. The BRICS nations have made no secret about the fact that they want to create their own reserve currency. They've said so much. It's, there's public headlines about it. I've written about it. So what do you have? Well, you have kind of this unprecedented moment where the US, in arguably its most precarious financial position ever in the country's history, with the amount of debt that we have, the amount of inflation that we're facing, the lack of productive capacity, the trade deficits that we have, this, just funneling money out of the country to Ukraine, the government spending, which is just off the charts. It's almost inconceivable how careless we are with our spending. We have completely lost our compass financially, this country. Completely. It's stunning. It's breathtaking, really, is what it is. I don't even know what hope there is if we were to cut government spending tomorrow and start to try to, rein some of this in. We have completely lost the Econ 101, compass of what a position of strength is financially, right? Mm-hmm. Is a position of strength having a strong balance sheet and, positive cash flow if you're a company? Yes. Well, it's the same if you're a country, right? You want a strong balance sheet and you want positive cash flow, right? Which means you want to bring in more in, tax receipts than you do doling out from spending, or more from trade than you do doling out from trade, right? And we're in the worst situation. We have the worst balance now, arguably, than we've ever had. And, I was listening to Larry Lepard while I was running today on some other podcasts, talking about Fort Dix and whether or not the gold is at Fort Dix. And I'm just running and I'm just thinking, like, of course the gold isn't there. You know why? Because if there's a string, Tom, they're going to pull that string before they do the responsible thing 999 times out of 1,000. Mm-hmm. And I guarantee you, and I think Larry's right. He said, this probably happened sometime before we got off the gold standard, that somebody just said, well, we got all this gold here. Might as well sell some to pay for whatever government program we were working on at the time, something that I'm sure is completely defunct, that, somebody has retired off of. But I'm sure we have. I'm sure we don't have the gold reserves that we claim we do, because the whole rest of our economy is a house of cards. Why wouldn't that be? And so if you're the West, if you're the BRICS nations, and you're looking at the United States now, what must you be thinking?
Mm-hmm.
What must you be thinking when you watch Joe Biden, hand over $100 billion over the course of the year to Ukraine, and then, abscond with another country's financial reserves, operating from a position of a deficit with a insolvent balance sheet, and your friends, the Saudis, are really what? They're the one thing that's holding up the dollar's reserve currency status. The petrodollar, is that it? Because the Saudis are they are entering into security agreements with Russia and China. The whole point was we were going to provide them with security, and that's why they were going to transact in dollars. So what's happening now? They're entering into security agreements with these other nations. And meanwhile, China, Russia, Saudi Arabia, India, they're not doing business exclusively in US dollars anymore. They're buying and selling oil in rubles and in yuan. So what does that mean for the dollar's reserve currency status? What is their backing that? What, our nuclear arsenal? Well, what good is that?
Yeah, this seems like a slow slide that is just going to, kind of pile up and pile up and pile up. And then, like you say, all of a sudden we're gonna wake up one day and realize that everything has changed.
Yep. And so people ask me my outlook on 2023, can the S&P move up 10%? It's like, who cares? I mean,
yeah, we have bigger problems than that.
Yeah. If it does move up 10%, well, what will happen? You'll have guys like Tom Lee go on CNBC and pat himself on the back for meeting his year-end S&P target. Everybody will, feel a little bit better on the golf course while they're looking at their 401k balance on their phone. But then we got to deal with 2024 and then 2025 and then 2026. And there's much bigger forces at play here than whether or not the S&P is going to return 10% or not this year. And that is all an aside to the fact that I'd like to mention Tom Lee's year-end target for 2022 was something like 5,100 on the S&P, okay, which means he got it wrong by almost a factor of 40%, which is just stunning because we're talking about indices again. We're not talking about penny stocks on the over-the-counter markets. We're talking about stock indices. So to be wrong by 40% is stunning. And I know everybody knows this, but I'm just going to say it anyways, that the fact that they continue to have somebody on that network and on all these networks that has been this wrong and has been unable to see what's going on, very similar to Cathie Wood, very similar to Ross Gerber. And we'll talk about Tesla in a second. The fact that these people continue to be brought on and hailed as heroes, the purpose is to see the big picture. If you want to master the game theory of markets, you have to zoom way out. You have to be able to look at everything from, the stratosphere, and then you have to look at everything through a microscope too. And you have to understand how all those different perspectives interact with each other. You can't ride like the most euphoric stock bubble in history and just continue to predict what really anybody could have predicted, which is that stocks will go up, and label yourself as an investing genius. Let's talk about Tesla real quick. The acumen of these managers gets put on full display, Tom, when the playing field changes, right? When rates are at zero and the Fed is doing unlimited QE, it's very easy to be an asset manager. You can buy garbage and it goes up. It's very easy. You don't even need to know how to read financials, right? And I'm still not sure that a person like Ross Gerber does know how to read financials, okay? When somebody like that goes and buys a company like Archimoto, for example, which I looked at the financials of the other day for the first time, as far as I can see, that equity is worth $0 tomorrow. I mean, it's just that company is basically bankruptcy waiting to happen, right? And I was looking at their cash burn and stuff. You look at somebody purchasing a company like that, even in the most perversely out of control, insane, euphoric scenarios, there isn't an excuse to buy that because, the play is, it's an EV company. Okay, maybe that would have been nice 3, 4, 5 years prior, but like even the EV bubble was saturated at that point, and it was still a bubble. The acumen of these individuals gets put on full display when the gravy train underneath it all stops, because all of the behavioral Pavlovian incentives that these geniuses had over the last 10 years, which essentially was, okay, let me buy the dip. Every time a stock goes down, I'll buy the dip, and that's it. And the market will just continue to move higher. We talked about this, me and you, with Kathy Wood and Robinhood, right? IPO'd at like 18 or something, couldn't find a bid at 18, went down after the IPO, went way up on a gamma squeeze. There were a bunch of call options bought. It went up on a gamma squeeze to like 38, fell to 30, and Kathy Wood said, I'm buying the dip. And it's like, no, actually, you're buying 2x the IPO price where it didn't have an actual bid to begin with. But she didn't understand the mechanics of what was happening in the market. She didn't understand the fact that was an artificial price for that company, right? So what did she do? She wrote it down to 8, all right? Congratulations. The acumen of these individuals is on display when the gravy train under it all stops. When rates go up and the free money spigot gets turned off, it causes the market to look at equities through a very different lens than it normally would have, a much more conservative lens, a much more risk-adverse lens, okay? A company like Archimoto, all right, that Mr. Gerber has in his ETF is as good as dead when a shift like that happens. I mean, the equity, in my opinion, that company is worth zero. Right now, on paper, as the financial stand, the equity is worth zero. For anybody to hold that company, really in any kind of environment, but especially in this environment, is, in my opinion, gross financial negligence. Okay? So Tesla's a great example of this, right? What happened in December 2019 heading into 2020 with Tesla, right? All of a sudden, right before the pandemic started, right around the same time I was listening to the World Health Organization do their first press conferences on COVID, which was, I think, December 2019, January 2020. I remember the coffee shop I was at. I was at Backyard Beans in Lansdale, Pennsylvania, where I was living at the time. I would go there every day. I'd work off my laptop. I was listening to the COVID press conferences through my headphones, and I was watching Tesla stock, and I had, my little news feed going also on my screen. And what I was seeing was large, substantial, massive, out of the money call option buys in Tesla, the likes of which I had never seen before. I pay attention to unusual options activity. I have, forever, since I've been trading, since I've been following guys like, Sang Lucci and Open Outcry for 10 years. So anytime option steam comes in on a name, I pay attention to it. Doesn't matter whether it's Tesla or whether it's Microsoft or whoever. It makes its way across my feed, and then I always take a look. Oh, is this a biotech? Okay, do they have results coming up, or is this a company leading into earnings? Because you always want perspective. Hey, does somebody in the options market know something? Mm-hmm. So with Tesla, what I saw was extremely unusual out of the money call option buys. It was 2020, Tom, and the stock, I think, was at, let's just say it was at 80, right? And split adjusted or whatever. We'll just say it's at 80, and the year is 2020. I saw people going out to 2025 and purchasing, $400, $500, $900 strikes, multi-million-dollar buys. Enough for me to just say those are extremely unusual options purchases. I'd never seen anything like it before, and not in Tesla. And I've been watching options trading Tesla forever. And what we saw after that was you see the equity react, right? Because market makers have to hedge their positions. The people that sell those option contracts have to get long a certain amount of the stock to kind of de-risk. And all of a sudden the stock went from 80 to 800, and that was that first huge run up.
in Tesla, where it was just like, oh my God, and they posted their first profitable quarter at the time, a penny or 5 cents per share, whatever it was. But they really fundamentally, that was immaterial, that amount of money. The move was astronomical compared to, what had happened in the underlying fundamentals. Now, I wasn't smart enough to catch the move on the way up. What I should have done was gotten long, and like all these imbeciles that really, made millions and millions of dollars, on their Robinhood accounts, just buying Tesla call options. It fueled basically a flywheel that started on its own, right? It was a self-fulfilling prophecy. Other people came in, they bought call options, whatever. Before you know it, you have Tesla that's 10x over the course of a year and a half. And because Cathie Wood and Ross Gerber and the likes owned it, they were rolled out on financial media as these incredible gurus. And, look, good for them. They made brands out of it. Cathie Wood made her whole innovation brand out of it. She's got the vision for innovation, Tom, that the rest of us just don't have, right? That's the problem. So that's why we need her ARK fund. Meanwhile, I could run a screen for companies with a PE, over 500 that, generate, no free cash flow yield and whatever, and just identify, the 100 worst, most overvalued, aggressively valued companies in the NASDAQ and probably go out and buy half of the ARK fund without even, looking at what was in it. But regardless, the stock goes up. These two all of a sudden are geniuses. And we are left with, essentially these two creating their own brands and becoming, poster children really for the bubble, the ride up. Well, now all of a sudden that's changed, right? And so we've seen Tesla was down, 50% last year or something like that, maybe even more, 65% last year. Well, the air is coming out of the bubble, right? What has changed? The gravy train, the aforementioned train, has stopped. So once that free money spigot turns off and people's investing attitudes become more risk adverse, people get forced to deleverage, like we're talking about, their appetite for risk comes down, then all of a sudden this thing starts working in reverse. And rather than understand that, rather than cash out after this thing 10x's, right? Because really all you had to do was look at the valuation once it 10x. When Tesla had $1 trillion valuation, no business doing that. What Cathie Wood should have done is said, I got this company that is worth all other auto manufacturers combined times 2. I won. I beat the game. Time to cash out and find the next opportunity. But instead, what she did was start making up all this other bullshit. Oh, well, this doesn't count for Tesla Mobility. This doesn't count for Tesla's energy, their insurance company, their solar company. So instead of recognizing it and recognizing that the macro environment was changing and taking some off the table, it became an exercise in how do I continue to justify holding this because, I'm on the record as such a bull for this name that maybe it would be devastating for me. Or maybe, she really just believes all this. I don't know. I'm not a psychiatrist. I'm not interested in trying to figure it out. The point of the matter is that when the macro environment changes and these people's attitudes don't change, okay, that's when you're going to see real pain. So I was having a discussion yesterday. Well, ARK is at 30 today. It was at 130, maybe a year and a half ago. Do you really think it could fall from here? Yeah, I do. I think it could fall another 50% from here. I think it could go to $15 because I think that Tesla can continue to move lower. And I think that a lot of the other components still haven't been roped in the right way. Mark Spiegel put out a note this morning, or I published his investor letter this morning where he says Tesla could fall another 90%. It's not inconceivable. And it appears like Musk, who is over leveraging himself and just pretty much going bananas, is doing everything he can to catalyze that. So a lot of people are going to get a lot of hard lessons because the fundamental footing of the market has changed. And that is what is guiding my predictions for extreme volatility in 2023. Not meaning, again, that the market is going to crash all of 2020. We're going to go down 95%. That's not what I mean. but I do mean we are going to see some pronounced move lower. We're going to see an overshoot of a reaction by the Fed, I'm certain, at some point. We're going to see the market continue to whipsaw higher, lower. It's just going to be a wild year because you have all these unknowns, Tom, right? Not only do you have the macro unknowns, you have all these geopolitical and global economic unknowns, right? What day is China going to come out and invade Taiwan? Because you know it's going to happen. And then what's our recourse going to be? Are we going to try to do sanctions like we did with Russia? Well, that maybe will work for 30 seconds. And China's going to come out and say, by the way, we have 10x the gold than we told anybody else, and we don't think Fort Dix has anything. Can you prove it to us? What do we do then, right? I mean, that changes things profoundly. Any one of these things can happen. Any one of them, God forbid, hopefully the war in Ukraine doesn't get crazier. Hopefully it doesn't turn into World War III. But there's more of a chance today of World War III, Tom, than there's ever been, like in the last 20, 30, 40 years. I mean, maybe going back to the Cuban Missile Crisis, I don't know. But, man, there's so many things that can go wrong right now. And to be a bull today, to say the market's bottom today, you have to be okay with saying, I'm all right with buying the S&P at 20 times earnings right now. The earnings that will be declining in the year coming, right? So maybe that 20 turns into 22 next year, 23 times earnings. But you have to be okay saying that. And I'm just not. I think there's way more of a chance that the S&P multiple goes to 12 than it goes to 25. So that's my outlook for 2023.
Well, Chris, you touched on a little bit of the crypto stuff. We saw Celsius blow up last year. Luna, obviously, FTX will be, let's say, closest in people's memories. Do you think that has changed people's outlook on crypto, changed people's way they think about it as an asset, as a trade, and does that in some ways maybe make Bitcoin more attractive again?
I don't really know, because my position on crypto has been skeptical since day one. What I will say is that Larry Lepard did a great job, the best job of anybody, in describing it on your last podcast with him in a way that makes me more curious about Bitcoin than I've ever been. There's a lot of unknowns. It's very, 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 very early for Bitcoin, right? It's been around 13 years. How could it, there's just so many unknowns. I think he's right when he says that the risk reward for Bitcoin specifically. So we'll talk about crypto in general, right? What did we know about crypto? Well, we knew all of these promises to pay ridiculous yields on crypto were just bullshit. I mean, if people were doing that with US dollars, it would have been massive banking fraud all over, and regulations would have stopped it. But because it was crypto, they kind of got away with it. Now, of course, it'll be regulated after these blowups, whatever. Bitcoin is not crypto, right? One thing I'm starting to understand, that I have started to understand, right, is that Bitcoin's a protocol, Bitcoin's a network. Okay, so I'm starting to understand that, and kind of what I've said all along, that, if we do continue to have this crypto winter, which I think will continue in 2023, because I do think there's significant risk still. Grayscale, Binance, could Saylor get carried out of the trade? Who knows? You got the whole Tether fiasco, the stable coins, Dogecoin still has $1 billion market cap or whatever. There's a lot of excess in crypto that still needs to come out. And as that comes out, it's going to pressure the price of Bitcoin significantly, no matter what. Having said that, do I think that Bitcoin had to come out of this the lone survivor, or the lone key survivor? I do think it will. I think it's likely that it will. I think it's likely that Bitcoin will survive. The only question is, what will it be priced at? Will it come out at $10 per coin, or will it come out at $1,000 per coin, or what will the bottom be? I can't even try to forecast those things, nor do I really even care. I'm more kind of focused on understanding, the potential use case for it, which now I understand a little bit better than I did beforehand, in the sense that it isn't tangible, it's digital. Larry made some really good analogs that helped me with talking about how people used to doubt software because, that software could be worth anything because it was just code on a computer, making some analogs between Bitcoin and the advent of the internet, which of course I had heard before, but didn't really fully understand. I'm still on my way to understanding it. I ordered the Bitcoin standard. I'm going to read it. I'm always going to be a gold first kind of guy. Or right now, when I talk about Bitcoin, I'm talking about a very negligible amount of money that I would invest, money that I'm 100% comfortable with losing 100% of. I do own some Bitcoin. I'm buying it, pretty regularly. That's been the case for a while, but I have been a skeptic, and I continue to kind of be like a show me first. But I think that as I understand it more, the asymmetry of the risk reward profile makes sense. It's essentially a call option. If guys like Larry are right, it's going to go up 100 times from where it's at today. And if guys like Larry are wrong and I'm right, it's going to go 100% lower. So I'm okay with that. The same way I buy a call option in a company because, I expect to make multiples of whatever I pay for it. And I expect to risk 100%. My risk is defined essentially at 100%, if you want to put it that way.
Mm-hmm.
I think that crypto is going to probably be a disaster heading into 2023 because I get the case that it's digital sound money. It makes sense to me. I understand it. The argument of whether or not it's sound money still, I know is still up in the air. I haven't really made a decision, but I get it. I'm starting to understand the use case for it. I'm starting to understand its advantages over gold, but also its disadvantages against gold. It makes a little bit of sense to me now in a way that it didn't. However, gold is still like my primary gold and silver miners, really where I want to be. Obviously, owning physical first is a number one. But I think Larry makes a very good case. And I think that if you go back and listen to the interview you did with him, he makes a measured case for it, which I think is important. Larry's not an idiot. Larry's a smart dude, all right? He makes a measured, cautious case for it, which I respect. I respect that a lot more than Michael Saylor telling people to go out and mortgage their house to buy Bitcoin. And regardless of whether or not Saylor turns out to be right, say he turns out to be the biggest genius of our generation, right? And he's the first guy to be worth $100 trillion because of his foresight here and how early and on the adoption curve he is, et cetera, right? That still won't justify making a statement like that. He's still an ass, in my mind, for suggesting that people do that. It's an irresponsible thing to do. And frankly, I think it's pushy. I don't tell people what to invest in, and I don't tell people how to manage their money. I talk about how I manage mine and what I'm thinking. It's up to everybody else to make their decision. So I just think he's an ass regardless. I think that Larry approaches it the right way, and he has worked through a lot of it. He's worked through a lot of the concerns that many, and look, he's an Austrian guy. He's a sound money guy. Right. So it's not like he's got this super low bar. He's not some guy that you drag in off the Wall Street Bets message board who's been buying shares of AMC for the last 2 years and say, hey, I got the next 100X for you. And that's all they need to hear. Mm-hmm. He's a thoughtful individual. And so I take what he has to say very seriously. And I don't know if it's just because I'm ready to hear it now in a way that I wasn't, or if it's because of how he put it, or both. But I am going to read the Bitcoin standard. I'm interested now in a way that I haven't been. But again, I'm not a 50-50 guy like he is. 50% Bitcoin, 50%. I don't think he is even. He said in his PA he's 50-50.
15.
Oh, is that what he said?
I think he's 85-15. Yeah.
I thought he said 50-50 PA, but even that is too risky for me. I just wrote a portfolio update for my paid subscribers, and I'm going to read it to you because it's been out for a couple of days. And I just wrote, look, first things first, I just want people to know that I think Bitcoin is 100% pure risk. And I wouldn't put anything into it that I'm, not prepared to lose 100% of. It trades like a risk asset, right? Mm-hmm. It goes up when the liquidity fire hose is on, and it goes down when the liquidity fire hose turns off. Gold kind of does the same thing, actually. Gold's kind of been trading the same way. It didn't rise when gold went up after the Fed started QE. So it trades a little bit differently, but it's not as, it's way, way, way more volatile than gold. And so you just kind of have to understand that it's so early on in the adoption curve, and it's so different in the sense that the supply can't be altered, and it's brand new, and it's, there's all these open-ended questions about it. The question is whether or not over the course of 20 years, 30 years, 50 years, whatever, that starts to smooth out and make sense, which is something I'm open to. Because, I used to say Bitcoin addresses the right problem, but it's the wrong solution. And I'm not sure that it's not part of a solution to the problem. Go ahead.
I was going to say, hate it or love it. I know a good part of our audience hates it, doesn't want to hear anything about it. There's others that might be open to it. And I try to take a stance of, I want to learn as much about these different asset classes as I can, because I want to be able to challenge something or let's say be able to change my mind on something. If I used to hate it and I'm presented with new information, I want to be able to be that flexible. I don't want to be that rigid in my thinking. I want to be exposed to these new ideas, and I want to hopefully help expose the audience to some ideas or not even ideas, but maybe different ways of thinking about an asset class. That doesn't mean I don't still love gold miners, silver, any of the EV metals, base metals, whatever it is. I'm still going to, have that as my base case, because I don't think that, energy need is going away. I don't think that energy production is going down anytime soon, or the need for, let's say, cleaner energy, things like that. But at the same time, I don't want to, let's say, necessarily miss the boat on some, reasonably valuable asset or arguably valuable asset that has created a lot of value for a lot of people just because I hated it. And I think that's an interesting point, that you're in some ways kind of changing your mind about how you see that.
I'm not changing my mind, because I've always been open to hearing the case for it. It's not like I've shut down, people's arguments about it. What I know is I cannot stomach the people that promote it. I can't stand the influencers. I can't stand, I watch somebody like Max Kaiser and how he behaves at a conference on stage, and it's just reprehensible. And I know he's worth $1 trillion and he got in early. There's no amount of money in my mind that makes acting like that acceptable. It just my personal opinion on ethics and how people should carry themselves in a social setting, and the people that I would surround myself with personally. That's not going to be the same as everybody else. Just my personal opinion. I can't listen to a guy like, Pompliano. I just can't do it. I can't stomach it. He just put out a thing last night. Oh, I'm sorry, I was pumping FTX. I'm going to remove all my sponsors from my podcast now. It's like, all right, man, too little, too late. But I don't know. I can't tolerate that. Maybe it's just my experience as a short seller busting frauds for a living and, penny stock garbage, and just seeing the way these promoters act. But I find that, I find the promotional nature of it just reprehensible, which is something that Larry talks about, right? He says that he thought it was a promote at first. The thing is, when you understand it, you understand that Bitcoin just stands alone on its own. It is what it is, regardless of whether or not anybody says anything about it. The protocol is the protocol at the end of the day. So, I think there is a sea of toxic waste surrounding Bitcoin, an ocean of toxic waste. And I think all of it needs to go away. And some of it, has been carried out in 2022. And I think more of it will get carried out in 2023. But if you can kind of compartmentalize it and kind of put Bitcoin on its own, and that's why I'm interested in reading the Bitcoin Standard, you might be able to look at it a little bit differently. That kind of stuff is a turnoff. It's hard to see through. I'm a skeptic by nature, but I have always said about Bitcoin, and I'll always say about any investment, that I'm open to hearing both sides of the story. It's only once you have a full, you have to leave ego out of it. You need to be able to have a comprehensive understanding of anything in order to make an investment decision on it, which means bring me the world's smartest bear and bring me the world's smartest bull and let me hear what both of them have to say. And I want to hear everything. I want to hear the comprehensive argument from both of them, And for Bitcoin, for me, it's kind of been frustrating in the sense that it's not going away. And I feel as though there are people smarter than me that understand it in a way that I don't. And that is a frustrating endeavor and has motivated me to want to understand it further because I know I'm not the smartest person in the world. So what I'll say is I continue to approach it with an open mind. I haven't really made any substantial changes as to how much I'm buying or anything like that, but I'm interested in reading more about it. And I don't know, I continue to have an open mind about it, but I'm still, first and foremost, and I think I'm always going to be, a gold investor. I mean, you don't replace 5,000 years of history as an economic instrument overnight. But do I think that there may be a case for both? Maybe, if you gave me $1 million tomorrow and you said I had to invest it in either gold miners or Bitcoin, the answer would be gold miners, and I wouldn't even think about it. Actually, silver miners, if you would let me, but I wouldn't even think about it. So, but I will say that once you differentiate Bitcoin from the rest of crypto, because Bitcoin gave birth to an entire industry of toxic waste, an entire industry of nothing. There is all of these other altcoins and stable coins and the companies that, Binance and FTX. And I mean, none of it is necessary for Bitcoin to be successful. None of it. The entire crypto industry isn't necessary. Bitcoin in and of itself is really all Bitcoin needs. The Bitcoin protocol is all that Bitcoin needs. So there's a very pure aspect to it that it's tough to kind of wrap your head around with all this other noise that's going on. Having said that, I'm not sure how it'll react if the Fed decides they want to, look, if the Fed says they're going to start cutting rates, I think gold's going to go to 2,500. I think we will see gold go up $500 an ounce at some point in 2 days. That's my prediction. I think once the Fed starts to make a pivot, I think we will see a move in gold, the likes of which we've never seen before. And I've been saying that. I wrote an article about it on my blog. I think that gold's heyday is coming. Starting to see it kind of bubble under the surface now, aren't we, Tom? Like there's been some interesting strength in gold here over the last maybe month. It was up $40 an ounce just over the last 2 days. And we're still in this hiking cycle, right? We're still in. Kashkari was out this morning, said we're going up 540 basis points, right? So why is gold reacting like that? This is the horse at the gate right now, just kind of like amped up on amphetamines, just waiting for that gate to open. And that's what I think these little bursts higher in gold are now. This is people starting to think about the idea, starting to think about thinking about the idea of what's going to happen when the Fed pivots. Never mind the case if the Fed loses control. I mean, we go to yield curve control, forget it. We go to yield curve control, gold's over $3,000 an ounce. I mean, it's just it's a total loss of control if that happens. All right. But let's just talk about pausing rate hikes. Right. Okay. Well, what happens then? Well, maybe we see $150 an ounce, whatever, then let's talk about easing. Oh, okay. Well, then, maybe good for another $150 an ounce. And let's talk about, turning the QE spigot back on and bond buying. Oh, all right. And then all of a sudden, you can take those kind of scenarios that seem like they could definitely happen and start to work your way up the spectrum of things that are a little bit less likely to happen, but still could very well happen, like yield curve control, like, foreign adversaries challenging the dollar's reserve currency, somebody like China. Hey, I said a year and a half ago, before the whole Russia war even started, before anybody was even talking about it, that China's going to back their currency with gold. I'm standing by it. I'm standing by the fact that they're going to back the digital yuan with gold. I think I'm right. I think we're seeing Russia now basically, in essence, create Petrogold, right? They're only accepting gold for their oil, or it's another step closer. And at some point, man, you take a situation like that where the reserve status of the US dollar gets called into question in a way that's undeniably, that we have to face, right? We can't financially engineer our way out of. Or you see something like, the Fed go to yield curve control or emergency 200 basis point rate cuts. That horse that's hopped up on amphetamines is going to run the fucking quarter mile at Santa Anita in half of a second, and break the world record by a factor of 1,000. And I think it's possible. As hate to keep bringing up Larry Lepard. I don't hate it. I love the guy, but I was just listening to him this morning. He makes the case that the government needs to suppress the price of gold and silver, specifically to kind of prevent this stuff. You have 100-to-1 claims on gold and silver. He's guessing. Let's just say that's the truth. It's going to be a fight to kind of keep the price down. At some point, international markets, are just going to make the call for us. It's just when the rest of the world is transacting gold for the equivalent of $3,000, $4,000, $5,000 an ounce in US dollar terms. What are we going to do? Say, no, we're pegging it to $2,000 an ounce. Okay, well, what do you have to back that up? Well, nothing. We don't have anything. As a matter of fact, we don't even have the gold we say we have. So we'll lose control at some point. So I feel great owning gold and gold miners. We talk about it every time we talk. There will be a spot where gold and silver miners, in my opinion, become nationalized because it will be the only sound money. So you get your 25, your 50, your 100x. You can make the life-changing amount of money. Start thinking about ways to either move that money elsewhere. Just think about the risk of those companies being nationalized, because you will not be compensated fairly when that happens. Just another thing to keep in mind. Whatever, 5 years, 10, 15, 20 years down the road, who knows? But these are the things that my paranoid brain thinks of.
Well, they're all important things to keep in mind, as I think, all these conversations are exposing ourselves, like I said, to new ideas and thinking about the near term and longer term effects and ramifications of these changes in the world. But Chris, I think that's a good spot to wrap up today's conversation. I know we touched on a lot here, and I hope everybody enjoyed it. Let us know. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.